8 days. Think about that for a second. 8 consecutive days of red candles bleeding across your screen, carving out a path of destruction through portfolios that once felt invincible. While the rest of the market is frantically chasing new all time highs, the most talked about company on the planet, the pioneer of the electric revolution, just watched billions in valuation evaporate into thin air. It's quiet now, but the panic in the comment sections and the frantic selling in the pre market tell a different story. We aren't just looking at a standard correction, we are witnessing a fundamental shift in the global power structure of the automotive and tech industries. Most investors are walking through this fog completely blind, reacting to headlines that are designed to trigger your fear, not your logic. But by the end of this deep dive, you're going to realize that the delivery miss everyone is screaming about, it's actually the least of your concerns and potentially the greatest opportunity of the decade. Hey guys, I'm Sean. Today, we are dissecting the Tesla volatility that has everyone from the retail traders on Reddit to the institutional whales in the big banks sweating. We're going to peel back the layers of the Q4 data, look at the brutal reality of the BYD takeover, and I'm going to show you exactly why the January 28th earnings call will be the most pivotal moment in this company's history. You're going to walk away from this video with a clear-eyed, data-driven strategy on whether you should hold, fold, or double down. Let's talk numbers because in a world full of opinions, the math is the only thing that doesn't lie, even when it hurts to look at. Tesla just pulled back the curtain on its Q4 production and delivery report, and let's be honest, the reaction was a gut punch. They produced 444,358 vehicles, but only managed to put the keys into the hands of 418,227 customers. Now, if you're new to the game, that sounds like a lot of cars, but in the ruthless world of high-growth tech, good isn't good enough. The street, the analysts who control the flow of billions, was expecting 428,850. That's a 10,000 unit miss. In a vacuum, 10,000 units is a rounding error. In this macro environment, it's a signal fire. But here is where most people stop reading. They see the miss headline and they hit the sell button. They don't look at the why. You see, there is a massive myth floating around that people have simply stopped wanting Teslas, that the brand has lost its luster. But here is the truth. We saw a massive artificial pull forward of demand in Q3 because everyone knew those $7,500 government tax credits were expiring. When the government stops handing out checks for $7,500, the average consumer doesn't stop wanting the product, they hesitate. It wasn't a lack of desire, it was a shift in the financial incentive structure that the market failed to price in. Imagine you're running a marathon, you've been leading the pack for 20 miles, and suddenly your shoelace snaps. You're still the fastest runner on the track, but you're limping. You're forced to slow down while the guy in second place gains ground. That's Tesla right now. The production capacity is there, the machines are humming in Austin, Berlin, and Shanghai, but the logistics and the transition to a new tax regime created a bottleneck that the Wall Street algorithms didn't account for. They saw a slowdown, I see a temporary friction in a high-speed engine, but there's a secret hidden in the back of that report that the mainstream media almost entirely ignored. While everyone was obsessing over the cars, the energy side of the business was quietly exploding. We are talking 14.2 gigawatt hours of energy storage deployed. That is a massive vertical leap from the 2 GW benchmarks we were seeing just a short while ago. This is the devil's advocate moment. If you think Tesla is just a car company, then yes, they failed the quarter. But if you view Tesla as an energy and AI ecosystem, they are just getting started. The cars are the Trojan horse, the energy and the software are the real empire. But don't get too comfortable just yet, because while Tesla was dealing with shoelaces in the US, a titan was rising in the East, and they just did something that most experts thought was impossible. They didn't just catch up, they took the crown, and they did it with a level of efficiency that should make every Tesla bull take a long, hard look in the mirror. The reality of the global market just shifted, and it's a cold, hard pill to swallow for the Tesla bulls. For the first time in history, the throne has been seized. BYD, the Green Titan from the East, officially outpaced Tesla as the world's largest producer of pure electric vehicles. We aren't talking about a narrow margin here, this was a statement. BYD's sales skyrocketed to 2.26 million units, a massive 28% jump from the previous year. Meanwhile, Tesla saw a 9% decline, pulling back to 1.64 million units. If you look at the chart right now, you can see the intersection point, the exact moment where the lines crossed and the inertia changed. It's a psychological shock to the system. For years, Tesla was the undisputed king, the only name that mattered in the EV space. But now they are the hunter, not the hunted. BYD is scaling with a ferocity that traditional automakers can't even fathom. They are vertically integrated in a way that would make Henry Ford blush. They don't just assemble cars, they own the mines, they manufacture the batteries, and they design the chips. They are flooding global markets with price points that Tesla simply hasn't touched yet. But here is where the devil's advocate comes in. People see these numbers and think it's the end of the Tesla era. They think the Tesla killer has finally arrived. But that's a superficial take. What we're actually seeing is a divergence of strategy. Think about it like the smartphone market in 2010. Everyone was looking at Nokia and BlackBerry's unit sales, obsessed with who was shipping more plastic handsets. Meanwhile, Apple was quietly building an ecosystem, the App Store, iCloud, the Silicon, that would eventually eat the entire industry's profits. BYD is winning the battle of the appliance car. They are making the best microwave on wheels. Tesla, they are pivoting. They are intentionally letting go of the low margin volume chase to focus on something far more lucrative. Does it hurt to see the number one spot go to someone else? Absolutely. Does it mean the business is failing? Not even close. It means the game has changed from how many to how much value per unit. I get asked this all the time. Sean, if BYD is so much cheaper, why would anyone buy a Tesla? It's simple. You don't buy a Tesla for the door gaps or the paint job. You buy it for the brain. You're buying into a neural network that gets smarter every time you pull out of your driveway. While BYD focuses on the hardware of today, Tesla is betting the entire farm on the software of tomorrow. But this pivot comes with a massive cost, and it's led us directly into the most dangerous territory for any investor, the valuation trap. Let's look into the abyss for a second and talk about the elephant in the room. Why is Tesla falling? Why has it bled for 8 straight days? The answer isn't just fewer cars, it's the weight of expectation. Right now, Tesla is trading at a price to earnings ratio of roughly 216x. To put that in perspective, the 5 year average for this company is around 100x. We are looking at a valuation that is more than double its historical norm even after this recent slide. When you buy a stock at 216 times its earnings, you aren't just buying a company, you are buying a dream that everything, and I mean everything, goes perfectly. You are buying the expectation that Elon Musk catches lightning in a bottle not once but 3 times over. Look at the comparison on your screen. You see that red line? That's Tesla. You see the other one? That's Palantir. Both of these AI titans have been moving in a tight, synchronized dance toward the floor. What we are witnessing is a massive valuation reset across the entire AI sector. The market is realizing that the gap between the price and the actual earnings has stretched like a rubber band, and eventually that rubber band snaps back to reality. A high PE ratio doesn't mean a company is failing. That's a rookie trap. It just means the market is impatient. It's like paying $500 for a dinner reservation 3 years in advance because you heard the chef is a genius. The chef might be incredible, but you're still sitting there with an empty plate for a long time. Tesla is currently in that waiting period. The earnings, the E in the PE ratio, need time to catch up to the P, the price. This is what we call a time correction. The stock doesn't necessarily need to crash to zero, it just needs to breathe while the fundamentals grow into the shoes we've already bought for them. If you sold every time Tesla looked expensive on paper, you would have missed the 1000% gains of the last decade. The real question isn't, is it expensive? The question is, when does the earnings growth start accelerating again? And that, my friends, is where the story gets very, very interesting. If you look at the projections for 2026 and 2027, something massive is happening under the surface. We are looking at what analysts call a double bottom in growth. 2025 was the trough, 2025 was the year of the struggle. But as we look toward the next fiscal cycle, the revenue growth is projected to jump from a stagnant 3% back up to 14% and then nearly 18% by 2027. We are moving from the investment phase where billions were poured into R&D for Optimus and the Cybercab into the harvest phase. Imagine a plane that's been taxiing on the runway for an hour. The passengers are getting restless, some are even asking to get off. But the pilot just checked the engines and they are finally reaching full thrust. We are approaching the takeoff point for the next leg of Tesla's financial journey, but there's one specific metric that the smart money is watching more than anything else. It's not deliveries. It's not even the PE ratio, it's the lifeblood of any empire, the operating cash flow. And right now, it's signaling a strong buy for those who have the stomach for it. But before you jump in, you need to understand the AI fog of war that's about to settle over the January 28th earnings call. This is it, the moment where the wait and see era officially dies and the execution era begins. We are standing at the dawn of 2026, and the roadmap that Elon Musk has been sketching on the backs of napkins for a decade is finally hitting the factory floor. If 2025 was the year of the delivery hollow, that agonizing valley where the stock stagnated and the bears felt vindicated, then 2026 is the year Tesla attempts to break the world record for a comeback. Let's talk about the first hammer blow to the skeptics. Optimus Gen 3. Forget the dancing robots and the parlor tricks you saw in the early demos. Right now, thousands of Optimus units, version 2.5, are already deployed in the corridors of Giga, Texas, quietly sorting battery cells and moving chassis parts with a precision that humans can't sustain for 8 hours, let alone 24. This isn't science fiction, it's a logistics revolution. By the end of this year, we aren't just looking at internal pilots, we are looking at the mass output of Optimus Gen 3, a machine designed not for the laboratory but for the assembly line. The myth versus truth here is simple. The myth is that Optimus is a distraction from the car business. The truth? Optimus is the car business. Imagine a factory where the labor cost drops by 90% because the workers don't need health insurance, sleep, or lighting. Musk has stated that 80% of Tesla's long-term value lies here. If he's even 10% right, the current stock price is a rounding error. We're looking at a production cost of roughly $10,000 per unit for a machine that can replace a $50,000 a year manual laborer. You do the math, but the real shock and awe moment happens in April. Mark your calendars because that's when the first cybercabs, the dedicated wheelless conduits of the Robotaxi network, are scheduled to roll off the lines in Austin. Using the unboxed manufacturing method, Tesla is aiming for a pace of 1 unit every 5 seconds. While the rest of the industry is struggling to make a profitable $40,000 EV, Tesla is building a platform purpose-built for a world that doesn't need drivers. People ask me, Sean, what about the laws? The government won't let a car without a steering wheel on the road. Here is the Q&A you need to hear. The question isn't if they will allow it, but who will allow it first. The dam is already breaking. Look at the Netherlands. The RDW has a scheduled date in February next month to demonstrate the safety protocols for national approval. Look at the shift in the US federal government toward the AV STEP framework designed specifically to strip away the patchwork of state regulations. Tesla has already clocked over 7 billion miles on FSD. The data isn't just a lead, it's an ocean that no one else can cross. And let's not forget the brains of the operation, Hardware 5 or AI 5, it's launching this month. We are talking about 10x the processing power of the current hardware. This is the moment the machine stops guessing and starts knowing. But here's the million-dollar question. If all this greatness is coming, why is the stock approaching a technical wall that has everyone terrified? You see, the stock market is a giant voting machine in the short term, but a weighing machine in the long term. And right now, the voters are nervous. We are approaching the 200-day moving average, the line in the sand for institutional investors. This isn't just a squiggly line on a graph, it is a psychological wall built of billions of dollars. When the price hits this level, the big money algorithms, the ones running in dark pools, start screaming. The myth is that these technical lines are magic. The truth? They represent the collective memory of every trader on the planet. Everyone sees the $400 level. Everyone remembers the last time Tesla was at this price before the Robotaxi hype. It's a retest of conviction. Think of the $400 support level like a trampoline. Every time the price falls onto it, the tension builds. The more people doubt the company, the tighter that trampoline canvas gets. Eventually, something has to give. Either the canvas rips, which would mean a drop toward the $350 zone, or we get a massive violent bounce back towards $600. Step 1 for you right now, stop looking at the daily candles. Step 2, look at the accumulation patterns of the whales. While retail is panic selling during this 8-day slide, we are seeing massive blocks of shares being snatched up at the $420 and $430 levels. The smart money isn't afraid of the delivery miss. They are positioned for the AI unlock. Sean, if the big money is buying, why did Truist and others lower their price targets? Great question. Analysts are paid to be right about next week, not next year. They are trimming their targets to $439 to play it safe, to match the current price so they don't look foolish if the earnings call is bumpy. But then you have Dan Ives at Wedbush, who is holding firm at $600. He's looking at the energy storage, that record-breaking 14.2 GW8, and he sees a diversified energy play that the others are too blind to notice. We are looking at a slingshot effect. The stock has been pulled back so far for so long that the tension is reaching a breaking point. The double bottom in revenue and cash flow is behind us. 2025 was the valley, 2026 is the climb. But there is one final piece of the puzzle, a black swan event that could leak before the January 28th call, something involving a secret update to the Optimus Gen 3 timeline that could change everything overnight. Are you ready for the final verdict? Because the next 48 hours are going to define your portfolio for the rest of the decade. So, where does that leave us? We've walked through the wreckage of the last 8 days, we've stared down the rising sun of BYD, and we've dissected the cold, hard math that Wall Street is trying to wrap its head around. When you strip away the noise, the sensationalist headlines, and the frantic notifications on your phone, three undeniable pillars remain. First, the financial metrics, revenue, EPS, and free cash flow are all projecting a massive U-shaped recovery that starts right now. Second, the pivot to AI and robotics is no longer just a vision on a slide deck, it's a production schedule with thousands of units already on the floor. And third, the $400 technical support level isn't just a number, it is the strongest psychological and institutional safety net we've seen in years. Your action guide for the next 48 hours is simple. Stop watching the minute-by-minute candles. They are designed to exhaust your conviction. Instead, prepare for the January 28th earnings call with a surgeon's focus. You aren't listening for delivery numbers, those are yesterday's news. You are listening for two specific things: gross margin stabilization and concrete timelines for FSD licensing. If Elon Musk confirms even one major OEM partnership for full self-driving, or if the automotive margins show even a 1% improvement from the floor, the valuation trap disappears instantly, and that $500 resistance level becomes ancient history. Tesla isn't just a stock in your portfolio, it's a high-stakes bet on the future of labor, energy, and intelligence. This volatility, it's the price of admission. It's the tax you pay for being early to the greatest industrial disruption of our lifetime. I told you at the very beginning that this journey would be worth your time because understanding the why behind those bleeding red candles is the only way to stay rational when the rest of the world is losing its mind. Remember those 8 days of red? In a year, they'll look like a tiny blip on a much larger, much steeper climb. The double bottom is behind us, the golden goose is hatching, and the runway is finally clear. The only question left is, do you have the stomach to hold through the turbulence until we reach the stratosphere? Thank you for staying through this entire deep dive. If this analysis gave you the clarity you needed to navigate this chaos, do me a huge favor. Hit that like button, subscribe so you don't miss our upcoming deep dive on the Apple Tesla AI Alliance rumors, and let me know in the comments right now. Are you buying this dip or are you waiting for the January 28th results? I'm Sean. Stay focused, stay disciplined, and I'll see you in the next one.